Well, I think I'm gonna stay in the same sort of thesis most of my presentation, but I'll start with what's being presented to us in the last few days, which is this tariff, policy by Trump, which is a big change on things, as we've seen. The estimates is actually substantially higher than what I have pointed out in this chart at about 20%. Um, we've seen maybe estimates of even higher numbers right now, could be even up to 10 percentage points higher than what it is there. Regardless of what it is, it's the largest that we've seen since the tariffs that were imposed back in the 1930s, of which it happened during the Great Depression. It was certainly what added to the Great Depression in a large way. We've had a decline of equity markets that maybe was leading up to the some of those tariffs being imposed. And this time around, we didn't see much of an impact in the market until now, until this big move. Although since the beginning of the year, we did see a underperformance of technology companies, and consumer discretionary was certainly very clear. But this is a difficult presentation, I would say, to be given, because there had been so many. Kevin point out a few, or some of the changes in the markets, but you sort of have to separate your long-term and short-term views at the same time. I mean, there's obviously, in our views, a lot of things that need to unfold for imbalances to go away. We're referring specifically to the overvaluation of the market. Now, these things don't get resolved in 2 days. But we also understand, or have a understanding of history, that these things, again, take time to unfold. And you have ups and downs, and these trends are extremely volatile as well. And I think the best way to the model to understand is looking at the internals of the market, but also trying to understand the cost for the risk that you're taking. And so, when Kevin was, if we go to the next chart, I think I have something else. Actually, let's go back to the first one, and I'll go quickly in some things. But basically, today's market is very different than yesterday, actually, in terms of reaction. Today we're seeing the dollar actually surge. Yesterday we saw the dollar literally plunge. Those two words, I mean it. I mean, the dollar is surging today relative to its history. And at the same time, yesterday was one of the largest moves we've seen in history as well. So there has been some big changes on the dollar reaction, despite the fact that the market was down exactly almost the same yesterday and today. So, and then you have emerging markets. Emerging markets did do okay yesterday, and today they're getting absolutely creamed. I mean, look at the Chinese equities, Brazilian equities, most of the Asian markets and European markets are all getting hit significantly. So it is a difference in the behavior. And the third one I would say that is also very significant for us and for folks that are watching this is the mining stocks that yesterday held up so well, and today are basically falling apart. And so, what are the real moves? Begs the question, and what are the opportunities that we can see here moving forward? Another thing I would point out, and this kind of big 2 days down, and now I think Kevin said about a lot of folks on TV, sort of pounding their chest and being so bearish at the moment. And VIX spiked to levels that we haven't seen in a long time. I mean, there's an old saying that it's a difficult proposition to be shorting the market when the VIX is above 30. We're 40s now, and so if you're putting what is the VIX? Is the implied volatility of the put options in S&P 500. So clearly, it's exactly the premium you're paying to protect your risk on the downside. But notice what's happening today. I mean, there's some separations as well. First of all, let's look at some risk assets that are linked to the market that usually should be going down today, and they're actually going up. And I know some people are going to say, "Oh, it's a different regime," and I don't think it is. I think it's just signaling that risk. Some folks are starting to buy the market. Bitcoin is up today. GameStop is up today. MicroStrategy is up today. Home builders, very consumer discretionary type of industry is actually doing well today. So these are signs of some folks are starting to deep the their toes into the market again, and I think it's important and relevant to point out. I do think there's a big risk for those that not a risk, but maybe a chance that we may see some sort of short-term positive negotiation development over the weekend. I think there's a sort of a perfect storm for that, or perfect moment for that to occur. So, be careful out there. So let's go to the next chart. Next chart is something that I think it's a very, and I'm speaking of my views in that case. And I think a lot of what I'm going to say is in line with Kevin's views and Crescat's views, but maybe not to the same degree of conviction in some of the things. And what I'm trying to say is, historically, during recessions, and I would argue strongly that we've seen this market reaction recently, and the toughness, maybe even political, but tough position that the Fed is in terms of how to behave in the situation, and potentially not being able to adjust rates and its policy until we see a much lower market in terms of equity performance, puts the probability of a recession discussion in a degree that I think it should be a lot more relevant. I don't think it's 50% anymore. It's maybe closer to 60 to 70% of a chance of a recession in the next 12 months. And I think a lot of people are forgetting one thing. Deficits are calculated on government spending divided by GDP. GDP matters. If there's a recession, you usually increase spending by definition, because the GDP level will decline, but also you tend to see an increase of spending, of which a lot of people are, I would say, ignoring the risk of that because of Doge and other things. But it's, historically, it's almost inevitable that we see that at some point. Now, I agree, we're probably going to see pain first, and then that's going to be the next level. But I can't help but start thinking that in the next 12 months or by the end of the year, we may actually see deficits increase relative to GDP. In average, if you looked at all these recessions we had since the 1970s, the level of deterioration in deficits is about 6 percentage points from the very first moment of a recession to the very end of one. And my view is maybe you won't see that same level of deterioration, but even if we see half of that, would be substantial. This is the main reason, one of the main reasons why I see a much more clarity and in the view of the short end of the curve falling substantially relative to the long end. I think that this is maybe a contrarian view. I don't know, but I do think that the 2-year yield is I looked at studying Druckenmiller and listening to him over the years and decades of what he's done, which is remarkable as a macro trader, macro investor. And it's to me, seeing where rates are even right now, after a big decline already, we're approaching 3.5% now. I would still argue that this rates could come down a lot more in this environment, particularly if we have a recession. And I have another chart that I'll show that as well. Let's go to the next chart. I'm not going to dwell on this, but just to show how VIX is, and then Kevin showed the chart. The only different take I would not different, but I would add to his point about the level of volatility where we are now is look back in the early 2000s and see how many instances of those spikes that we saw during that time. I would suspect that we're probably in a regime that will look like that. That we saw, several spikes across that 40 and go back to 20 and then go back to 40. And if you study those spikes, every time you got above the 30 and 40, the risk of being short the market increased substantially. At the same time, every time you went back to the 20s, the risk of being long the market increased substantially. And And so to me, this is a good framework of understanding risk of adding position and taking profits on if you're in this at least for us, we've been deploying capital. So let's go to the next chart. The same goes to this one as well, of which I think that the fear and greed index in at the very bottom of the COVID recession that we had, and that crash in March 18th, I think was the very bottom of this index. I believe we hit the exactly same number 4 in terms of extreme fear. And this index is a good index because it looks at a lot of different things, in particular the credit spreads that we watch so closely, in financial conditions indices, and things are probably in that front of extreme fear right now, and I would suspect that at some point we'll go back to the neutral and greed area, and then we'll have another opportunity to be bearish in an extreme way once again. And I would also mention. Well, let's go to the next chart, because that's sort of irrelevant at that point. But here is something that Jay Powell actually commented in the past, that he said, "I'm not seeing the stag and I'm not seeing deflation." And so I separated stag inflation. So you've got sort of two phenomena happening right now. Short-term inflation expectation, or the break-evens, which is the market expectation of the CPI, is in the white line, and the red line is the 2-year yield in nominal terms. And so you've got a decline of the 2-year yield, that at the same time you did see an increase of inflation expectation by the market. So inflation has been increasing, and stag has certainly been developing in the markets near term. So basically, we didn't see much of a decline in inflation expectation near term, and we're pointing to 3.26%. Now, my view is that I do think the Fed is going to be very stubborn on reducing rates quickly, and I think we're going to see much lower markets before the Fed being able to justify lower rates. The Fed was actually asked that question today in its interviews, and of which, what would you do if you have the labor markets showing deterioration, but at the same time inflation rising substantially? In other words, what do you do if you have stagflation? How would policy respond? Would it respond to deflation, or would it respond to the stag? And his answer was, it depends on how much of the stag or deflation is away from its target. The one that is farther away from the Fed's target would be the more relevant one to be emphasized when it comes to imposing policy. And I don't think any of these two are too far from the Fed supposedly target right now. And I think that we need to see the stag develop a lot further in order to justify a change in stance by the Fed. And you can talk about the political aspect. I certainly think that the Fed could be political here. But it doesn't matter. You can even make the point that if they just look at the data that they think it's relevant, CPI, PCE, and all sorts of other things, instead of true inflation, which a lot of people have been pointing out that has been declining, and even the market expectation of long-term inflation expectation on the break-evens that has been in a different position. Maybe you could justify that, but it doesn't seem like the Fed usually looks at those things, at least historically, to form an opinion. And so this is why, even though people say CPI is not relevant, it is for policymaking, and you have to pay attention to it. So let's go to the next chart. In the next chart, I'm showing something that I have high conviction, specifically, and in the 2-year yield idea. I think that I point out to this breakout that we saw back in 2021, actually, when inflation got out of control. Then we saw a historical breakout of these short-term rates. And every time we actually hit that line, as you can see in this chart, it actually coincided with recessions, So when 2-year yield was gradually being the next peak that you see here was always a lower peak, and so we had lower highs formation in this chart, technically speaking, until now. And I would suspect that we're probably going to retest that level once again, of which is substantially lower than where we are right now. And this chart was done a few hours ago, so it's quite updated in terms of the number there in 3.58%. So it's a high conviction that I think that the rates in the 2-year will have a high potential of being reduced substantially. Let's go to the next chart. And if you look at the inflation expectation curve in the market right now, you can also see that the 2 versus 10-year break-even are now inverted in a very significant way. So basically, the market is worried about inflation near term and not as worried about inflation in the long term. And so you can see that this inversion of the 2 versus 10-year break-even, which is something we did see at the last inflationary environment of 2021, when we saw the first wave of inflation as well. So it is important to see that inflation expectation on the curve itself is behaving like we are in a near-term inflationary problem here as well. Let's go to the next chart, which could add to the Fed, being stubborn. Now, this chart is extremely important in my view. So, 2 days declines. Interesting that Bloomberg had that chart that Kevin was showing of the 2 days declines being one of the largest in history. But look back, what I think it's just adding to that point that I think is extremely relevant is that when we had those 2-day declines in those times, actually it was very close to some important bottoms in markets. I mean, the 2008 era there that you see in this chart took a bit longer, but you can see that the Fed was already cutting rates substantially. The Fed rates were at about 1% during that time when we saw that big decline. The one in during the COVID crash was rates were about slightly higher, about 1.25%. And just to give you some sense of how off we are, with the level of turbulence that we're seeing in markets, and how the Fed is unlikely to step in anytime soon, in my view, and we're still at 4.5%. And so, when I see these rates where they are, I can't help but think about things like the credit spreads and all sorts of things are yet to blow out even further, much higher. But near term is a difficult. It's difficult to commit to that idea right now. But certainly rates are substantially higher than they were during other times of turmoil, of which could be the level of stubbornness that can be very important, critical to sort of cause further deterioration. By the way, usually when back in when those similar tariff policies were imposed back in the 1930s, we did see rates actually go from 6% or so from the very peak of the market all the way down to 2%. So they were cut by 2/3 as those tariffs were imposed. And right now we're about 4.5% on the Fed funds. I could certainly see a world where when things just start to really deteriorate, causing the Fed to actually act on things, and the Trump actually pressuring Jay Powell quite substantially, especially in a tweet today. I would suspect that later on, once things get a lot worse, the Fed will be forced to cut rates, and this is why the 2-year yield will probably signal that much quicker than the 4.5% that you're looking at in the screen, which is the overnight rate. Let's go to the next chart. This decline of the dollar that we saw yesterday and not today, and I thought I'm sticking with my view here because it's so important when you have those big changes in markets, when the dollar is falling along with the market falling. And it reminds me of this cover magazine by the Economist, of which I have a collection of covers, of magazine covers and newspaper covers. In fact, I own that one. But I find it interesting that these covers are terrible timing indicators and actually great timing indicators when it comes to contrarian views about what's been published. And in this case, is that the dollar was doing so well during that period as Trump was increasing the probability of getting elected and so forth. And the market was basically rewarding the dollar versus other fiat currencies at that time. And that was when this cover came out. And I was really forming a very bearish view on the dollar at that time, of which we put out 2 or 3 letters specifically about that bear case, of which was wrong initially. And now finally we're seeing the first moments of that, what I think it's the first inning of that long-term decline of the US dollar versus other fiat currencies. So if we go to the next chart, you can see what I mean by that first inning. I do believe we're in the process of a major rotation in the market, and I can't help but also point out the fact that yesterday I put out a chart of gold outperforming the S&P 500 over the last 10 years. I mean, who'd have thought? It's been so much. Yeah, recently people have warmed up to the metal, but there has been so much skepticism about gold being a pet rock and it doesn't have a place in a portfolio. And now, I mean, it just outperformed the S&P over the last 10 years. I mean, it's something to be aware of. But at the same time, I also think that it means that we're entering a phase. This is just my views, that hard assets are likely to outperform the S&P 500. Now, I understand that this chart, the white line in this case, which is commodities to equity ratio, has been shown by other people, including myself, many times in the past. But what it hasn't been shown is the blue line. And when the blue line turns, which is the dollar, is when really you tend to see this rebalancing globally of one thing to another. So the dollar is at its second most overvalued level in history today. The other time we saw similar overvalue levels was in Plaza Accord in 1985, of which was a coordinated act to devalue the dollar, the blue line in this case, causing the white line to rise. This is where we saw emerging markets do very well. We did see Japan at that time. It went through an inflating process of its own domestic bubble at that time as well. And I think we're going to see something similar this time around with a lot of economies that have been neglected for a long time and hard assets that even today are suffering. And so for those that take a very long-term approach, these, in my view, are windows of opportunity as well. Let's go to the next chart. In this chart, you can see something that it's new and it's just starting in terms of behavior. Is the red line is the dollar, and the white line is financial conditions. Financial conditions have been tightening recently because of what's been happening, and credit spreads have been rising, and even other signals have been valuation have been contracting, and all sorts of things that usually go into that white line. But what people are not mentioning is the fact that the dollar is reacting the other way. So the dollar is devaluing as the financial conditions are tightening, of which, as you can see in this chart, is a new relationship that we're seeing now. And I believe this means that the dollar is no longer a safe haven, as a lot of people thought, especially the regime that we saw back in 2008 when the dollar was indeed a safe haven. I don't think we'll behave that way in this cycle. And so this is why I'm pointing this out. If you listen to Steve Moran's interview actually last week, which to me was probably the most relevant interview that we've had out of all these speakers out of the Trump administration recently. I think it trumps a lot of interviews that we've had over even since the tariffs were imposed here. But the meaning of it was or what it was meaningful was actually his communication towards how much the administration is focused on reducing this issue with trade deficits being so chronic over the years. And I don't know how you fix that without devaluing the dollar substantially versus other fiat currencies. And so I think that's just part of the policy in my view, and therefore why outside of the organic issues that we may see causing the dollar to devalue, I think there's also actual interest of the government to. Let's go to the next chart. Next chart is a chart that was sent to Peter Kraut sent to me this chart, and I thought was a great way. He knows that I have a view about the rest of the world outperforming the U.S. in the next decade. And a fidelity chart, it's hard to see, but it's basically looking at regimes, different regimes over all the way to the 1970s, when we have, the blue is the U.S. The red is the U.S. outperforming, and the blue is the rest of the world outperforming. And it basically shows how much of an outperformance period we've had for the U.S. this time around, and the likelihood that we may see actually the blue come back around and do much better. And so notice the 1982 era, which was that period when I showed the Plaza Accord and that transfer of capital from the dollar to other fiat currencies and other non-dollar based assets that benefited tremendously. And that was one of the biggest outperformances of the rest of the world versus the US. This to me is a very critical chart. I mean, this is such an important aspect or I'd say point to that gives me conviction to have that view as well. Let's go to the next chart. The next chart, I'm looking at the gold to oil ratio. I'm almost done with my presentation. This gold to oil ratio today is surging. Oil is down twice in a row. Look, I'm pointing out a lot of things that I and we have been right recently. Let me point out one thing I've been very wrong. Oil. I've been very bullish on oil. And boy, I had my face ripped this last few days. Oil is down, substantially this last 2 days. And my view on oil has always been about the fact that we've had so much deglobalization trends. And I believe that oil is I'm just simplifying the thesis, is a great way of a proxy of issues geopolitically. And given what oil prices are in terms of levels right now, relative to all the problems we have in the rest of the world, I can't help but see some sense of asymmetry in terms of upside for oil prices moving forward. And so to me, this is an interesting setup, especially when you have oil really cheap relative to gold now. But the other thing that this brings to the table is the fact that if you're running an open pit mine, if you're in the mining industry and you're running an open pit mine, that just means your margin just improved substantially. Well, that's interesting. We haven't seen margins like this for mining companies for many other reasons, because of how much metals went up, gold specifically, but also now because energy prices are falling. And so this is a very important development as well for the mining industry, particularly the producers in this case that have open pit projects, of which in average you would account for about 30% of energy cost in most of these open pit projects, just an average. All right, let's go next chart. Same thing is if you look at the gold to silver ratio, then now it is at 102. Who would have thought the silver would be technically oversold at near $30 an ounce, with a gold to silver ratio of 102. And on top of it all, how long do we usually stay at these levels? Now, you can look at the chart yourself and do that. And the other way to do it is maybe look at the performance of silver after you hit those really extreme gold to silver ratio moments. And I suspect that after one of the largest 2-day declines in silver prices in its history, I suspect that a lot of this is overdone as well. But again, that's just my 2 cents. Let's go to the next chart. Lastly, point out there are 2 things. I mean, similar to those two-day changes that I was talking about. Here's one that shows the gold equities and silver equities, the Philadelphia Stock Exchange. The bottom, you see the 2-day changes, of which we saw a substantial decline. It's actually, I'm sorry, this chart is 1-day change. It's just the only mistake is in the subtitle. It's 1-day change in this case, and you have almost 9% decline. The last times we saw this was during the COVID era, of which marked a major bottom. The same thing happened in about 2015. We saw the same thing in 2008 and also in the early 2000s. The other moment that I didn't point out that is in red, as you can see there, it was in 2013. Now, maybe you can make the case that we're in one of those, but I don't believe that's the case here. Now, I don't think 2013 margins were as fat as they are across most of the companies, number one. And I also don't think central banks are buying gold and creating this sort of fundamentally bullish environment for metals like we're seeing right now. And so I would certainly argue against that period as a risk to the idea of potentially taking advantage of what I think it's an overdone reaction by the market today. Let's go to the next chart. The next chart is a 2-day change, by the way, but you can see here 14% decline in energy equities. What I find interesting about this chart is a lot of things. Well, let's look at the recent reaction. It's been sort of a consolidation moment for about 3 years of energy equities. Usually these long-term consolidations tend to be resolved with a major breakout, particularly when you can see the prior peak was in 2014, and potentially is causing this pause and this resistance is supposedly because of that peak. And I know we've been working through that peak for a long time. I suspect that we're getting very close to a resolution that we may see a major breakout historically for energy equities. I can't help but be bullish on this. Also, when you look historically, other times, at least all the way back to 2002 or so, you can see that all other times that we've had this major declines in 2-day changes of energy equities also cause were great opportunities, window of opportunities to be deploying capital. So again, these are all my opinions. I don't have any certainty in markets, and any crystal ball that you may be looking for is certainly not the case. I'm just trying to take some emotions out of the market and point out some of these big changes that we've had recently, big volatility events that usually can be very, very productive for investors that take a long-term view.